Okay, friends, let's continue now. Friends, let's move to question 31. Again, it's on factoring. You will understand the difference of this question. Navya Limited has annual credit sales of 45 lakhs. Credit terms are 30 days. Management of receivables have been poor, and collection period is 50 days. Bad debt is, guys, 0.4% of sales. Factor has offered to take over the task of debt administration and credit checking at an annual fee of 1% of credit sales. Navya Limited estimates that it will save 35,000 on credit administration. Due to the efficiency of Factor, average collection period would reduce to 30 days. Bad debt would be 0. Factor will give 80% of invoice debt and annual interest. Whether Factor service should be accepted or rejected, that's the question's requirement. Now, these type of problem also you can calculate effective cost of factoring and answer it. But in a question there is one scenario where you will be normally giving a credit period of some 50 days, 60 days. But because factor has come in, he'll be able to collect the money faster. If that is there in a question, in that situation, effective cost of factoring cannot be calculated. For example, today the collection period is 50 days. If you move to factoring arrangement, it will be 30 days. This problem cannot be solved under effective cost of factoring route. It cannot be solved under effective cost of factoring route. Let's do cost benefit analysis of factoring arrangement. Cost benefit analysis of factoring arrangement. Particulars calculation amount. Benefits, costs. Let's read from the beginning. It has an annual credit sale of 45 lakhs. Credit terms are 30 days, but its management of receivable has been poor. Average collection period is 50 days. The first benefit for me is interest saved. What is interest saved is 50 lakhs. As of now, it takes 50 days for collection. This will come down to some period. So this is the overall interest saved, but I'll be incurring some interest cost. I'll factor that in sometime. As of now, I'm having an overdraft at the rate of 10%. So moment I bring in factor, I'll save this money. Will I incur something else? Yes, I'm going to incur something else on this. I'll come to that in some time. So this is the first saving. We will save some 68,000 because of factoring arrangement. 68,000. Then bad debt is 0.4. Bad debt will not be there. 50 lakh into 0.4%. This is the second saving. A factor has offered to take over the task of debt administration credit checking at an annual fee of 1%. This is the expense fee. 50 lakh into 1%. 50,000. Navya Limited estimates that it will save 35,000 in credit administration. 35,000 saved. Due to the efficiency of the factor, the collection period will reduce to 30 days. It's not becoming 0, so my interest cost will still be there. To factor to bank. Listen, 50 lakh. Good part is it will be now only 30 by 365. It will be only 30 by 365. The problem is factor will give me only 80% of the money at an interest rate of 11%. So I will get 80% from factor at 11%. I will need balance 20% also. I will get that from the bank at 10% rate of interest. I'll get that from the bank at the rate of 10%. So I don't save that entire 68,000. I incur some interest cost, but this is going to be lower than that 68,000. Sorry, credit sales is 45 lakhs. Okay, sorry, I've done everything on 50 lakhs. Okay, let me complete this question on 50 lakhs. The question says credit sales is 45. Sorry, in a hurry, I've taken it 50. So let me complete the entire problem on 50 lakhs itself. 30 by 365. Sorry about it, but let me complete this in this rate itself. to bank will pay 20%, 10. So the average collection period will reduce to 30 days. Bad debt will become nil. We have analyzed bad debt. Factor will give 80%. We have considered that interest cost is currently financing at 10%. That's also considered. So everything is done. Now we'll see the net benefit or the net cost. So these are the benefits. These are the extra cost. Net factoring arrangement is beneficial. All the calculation have been done for 50 lakhs. I should have done it for 45. I should have done it for 45, but broadly the calculation will be the same manner. 45 into 0.4% into 10, 30 by 365 into 80 into 11 into 10. So net the factoring arrangement is beneficial. Can you do effective cost of factoring in this question? Not possible. Effective cost of factoring is not possible for type of problem where there is a reduction in the credit period. Let's come to 32. A company is considering to engage a factor. The following information is available. The current collection period is 90 days. 0.5% of debtors default. The factor has agreed to pay the money due after 60 days. After 60 days, and will take the responsibility of any loss on account of bad debt. So earlier money was coming in 90 days. Now the money is going to come in 60 days. So again, effective cost of factoring is not possible. Annual charge for factoring is 2% of turnover. Admin cost saving is 1 lakh. Annual credit sale 1 crore 20 lakh. Variable cost is 80%. Cost of borrowing is 15% should the company enter into a factoring arrangement. So let's quickly do the cost benefit analysis. First cost is this 2% of turnover. So 2% into 1 crore 20 lakh, that is on the cost side. Administration cost saving is 1 lakh, which is on the saving side. Bad debt is 0.5% into 1 crore 20 lakh, 0.5% into 1 crore 20 lakh. So that will also come in the saving side. Another saving is, earlier I was incurring interest cost technically for 90 days. Now I will incur interest cost only for 60 days. Factor is not giving me money and all. Factor is not giving me any money. I am not going to pay any interest to the factor also. I am going to pay interest only to my bank. But the only difference is, earlier our interest was calculated on 90 days. Now the interest is calculated on 60 days. Now the interest is calculated on 60 days. This one issue or one debatable area is, they have calculated debtors based on cost of sales. They have calculated debtors based on cost of sales. Logic for this is, factor is not going to give me money. Factor is going to collect the money in 60 days and give it to me. So earlier I went to the bank and asked for a loan for 90 days debtor. Now I will go to the bank and ask for a loan only for 60 days debtor. When we were doing your extension of credit policy or reduction of credit policy, we were calculating debtors based on full cost of sales. In factoring, I said it has to be on sales. It can't be on full cost, because debtors, my factor should not know what profit margin I am making. So he will not get to know. But here factor is not giving a loan. So the debtors have been calculated on cost of sale. The debtors have been calculated, and there's a saving in interest cost of 1,20,000. There's a saving in interest cost of 1,20,000. Net there is a benefit of 40,000. You go ahead with the factoring arrangement. Okay, this is on a payable, I think, question. A Limited is in the manufacturing business. It acquires raw material from X Limited on a regular basis. As per the terms of the agreement, payment must be made within 40 days of purchase. However, you have a choice of paying 98.50 per 100 if you make the payment on 10th day of purchase. Examine whether A should accept the offer of discount. Average billing is 10 lakh, alternative investment yield of 15%, and company pays the invoice. So the point is, what happens in my cash discount is, I can pay 98.50 today. I can pay 98.50 today and save 100 rupees. This is paid on 10th day. This is saved on 40th day. Indirectly 98.5 will become 100 rupees in 30 days. Today pay 98.5, save 100 after 30 days. Today pay 98.5, 10th day. You pay 98.5 on the 10th day, and you can save 100 rupees by day 40. So the return here is 100 minus 98.5, this is my return, divided by 98.5 into 365 by 30 into 100. Tell me the percentage here. Okay, so I earn a return of some 18.5. The alternative investment will give me a return of only 15%. So it makes sense for me to avail the discount. It makes sense for us to avail the discount. 34 is something you can manage. Let's go to those additional questions. In that, I just want to discuss one question alone. Okay, I just want to discuss this question 24 alone. Only 24. Alliance Limited, a petrochemical sector company. Question 24, page 208. A petrochemical sector company had just invested huge amount in its new expansion project. Due to huge capital investment, the company is in need of additional 1,50,000 in working capital. There are following plans. The company's bank will lend 15%. A 10% compensating balance will be required, which otherwise would not be maintained by the company. I'll explain one by one of each scenario. The bank will give me I need 1,50,000. Bank will give me a loan of 2 lakh, or he can even give me a loan of 1,50,000, whatever I need. The problem with the bank is, if he gives me 2 lakh, he'll say deposit 20,000 in your account. A 10% compensating balance. 10% compensating balance. Let's assume I go to the bank and take a loan of 100 rupees. On 100, I have to pay interest of 15 rupees. But how much money I can use? Only 90 I can use. Only 90. So indirectly, my interest cost is 15 rupees on 90 into 100. 15 rupees on 90. Because 10 rupees I cannot use. 10 rupees cannot be used. This is 16.67%. This is the first option. Second option is, company has offered credit term from its major supplier of 3 by 30 net 90. 3 by 30 net 90, that is pay 3% discount, pay 97 rupees on day 30, pay 97 rupees on day 30 and save 100 rupees by day 90, save 100 rupees by day 90, 3 by 30 net 90, 3 by 30, pay within 30 days, get 3% discount. So my return is 100 minus 97 divided by 97 into 365 by 60 into 100. 365 by 60 into 100. You are going to basically get a return. You are going to basically get a return of 3% for a 60-day period. For a 60-day period. So 100 minus 97 by 97 into 365 by 60. Pay 97 today. Save 100 rupees 60 days later. Or pay 97 by day 30. Save 100 rupees by day 90. A factoring firm will pay the company's receivables of 2 lakh per month, whichever collection. The factor will advance up to 75% of the value of the receivables. At 12%, the factor will charge commission. Okay, I'm not getting into this part. This is basically you have to do the cost of factoring. The format which I said. You'll have to do the cost of factoring. Effectively, it is some 20%. The cost of factoring is 20%. Whichever is the cheaper cost, I'll go ahead with that funding. I'll go ahead with that funding. Okay, we'll go to dividend decision. This is the last area. You go through this. I'll be back in 2-3 minutes. You go through dividend decision. Okay, let's come to the last area, which is on dividend decision. In this chapter, the focus areas are, we are trying to find how the dividend of a company affects the share price. For example, Modigliani Miller approach, whether you pay 10 rupees dividend, 2 rupees dividend, or you don't pay any dividend, the value of the firm is not impacted. So the share price can go up or come down, the value of the firm will not change whether you pay dividends or you don't pay dividends. So we may have to do problem where we have to prove this fact. Then we have Walter's approach, which is an approach to calculate the share price also. The share price is calculated as D by KE, dividend by KE, plus R by KE into E minus D whole divided by KE. There is one part called as dividend by cost of equity, another part called as retained earnings by cost of equity with a multiplier effect to that. Under this policy, it depends on the relationship between R and KE. Depending on the relationship between R and KE, we may decide whether to pay dividends or not. The dividend payout can change based on the relationship. If R is equal to KE, any amount of dividend can be paid, indifferent. If R is greater than KE, dividend should be 0. If R is greater than KE, dividend should be 0, and if R is less than KE, dividend should be 100%. Then we have something called as Gordon's model, where the dividend is again calculated. Dividend is equal to, or price is equal to, D1 by KE minus G. This is an extension of the formula which we used to do. K is equal to D1 by P naught plus G. G goes this side. KE minus G is equal to D1 by P naught. P naught goes this side. D1 by KE minus G. Apart from this, there are, I think, other two models are there. I don't have any problem on them. One is on Graham and Dodd model, where the price of the share, according to this model, it is better to pay dividends. It is better to pay dividends. That's all. It does not say any relationship and all. Price is equal to some multiplier into dividend plus earning by 3, not retained earnings, earning by 3 itself. So maximum dividend should be paid. If you pay, if you have an earning of 12 rupees and you pay 12 rupee dividend, 12 plus 12 by 3. If you pay only 4 rupees dividend, it will be 4 plus 12 by 3. So the earnings remain as it is. On top of that, dividend is added and then is a multiplier. Lindner's model is basically going to tell how much dividends are to be paid. It does not have any effect on the price of the share. Let's first look at Modigliani Miller problem. Let's come to question 1. X Limited has 8 lakh equity shares outstanding at the beginning of the year. The current market price is 120. Board of Directors is contemplating 6.4 per share as dividend. Rate of capitalization is 9.6%. Based on approach, calculate the market price when the dividend is declared, not declared. How many new shares are to be issued if the company decides to fund an investment, assuming the net income for the year will be 1.6 crores. Now, I'm going to directly do it in one format, all the requirements of the question. Some extra things also we are going to do, because some other question can ask extra information. Working note 1, analysis as per approach, particulars, dividend declared, dividend not declared. 2 scenario, dividend declared and dividend not declared. First one is price today. Price today. What's the price today? What's the current market price? 120. Cost of equity. How much? 9.6. Dividend. How much the dividend the company wants to pay? 6.4. This side 0. Okay, now listen. MPS at end of year. MPS at end of year. Listen. What I want to know is 120 is my price today. This should go up by 9.6% and I should make it 131. This is my requirement. 120 should at least go to 131.52 because I need a return of 9.6%. The cost of equity is 9.6%. So investor needs a return of 9.6%. So he is saying, can you make 120 as 131.52? Company says, I will give you dividend of 6 rupees 40 paise. So the price will be 125. On top of that, dividend will be 6 rupees 40 paise. Price will be 125. On top of that, dividend will be 6 rupees 40 paise. You will get your 131.52. So the price at the end of the year is equal to opening price into 1 plus cost of equity minus dividend. 1 plus cost of equity minus dividend. Then total investment. The question has said some investment to be done. How much is the investment to be done? 3 crore? 3.2 crores. Total earnings. How much is the profit they have earned? 1 crore 60 lakhs. Less dividends, retained earnings. Less dividends and retained earnings. How many shares are there? 8 lakh. So I will have to pay dividend of 8 lakh into 6.4. This side dividends are not paid. This side dividend is 0. One side dividend is 8 lakh into 6.4, which means I already retain so much. I retain 1 crore 8 lakh and 1 crore 60 lakhs. I have a retained earnings of 1 crore 8 lakh, which means fresh equity. Fresh equity is I need 3 crore 20, in that 1 crore 8 is available, 1 crore 60 is available, balance has to come in the form of fresh equity. Balance has to come in the form of fresh equity. So I need fresh equity share of 2 crore 11 lakh 20,000 and 1 crore 60 lakh. Fresh shares. This divided by 125 and this divided by 131. Divided by 125 and divided by 131, I have to issue so many shares. So one of the requirement of the question would be how many shares are to be issued. How many shares are to be issued. So I need 2 crore 11 lakh 20,000 divided by closing price, because at the end of the year you will make this issue. Closing shares, closing value. How many shares are there originally? 8 lakh. So I end at 9 lakh 68 and 9 lakh 21. And the value of this is this into 125, this into 131, both will be same. Some rounding of difference can be there. Both will be same value. Whether you pay dividends or you don't pay dividend, the value of the firm is going to remain same. Closing price is equal to opening price into 1 plus cost of equity minus the dividend which has been paid. That will give you the closing price. Closing shares will depend on how many shares you are issuing. Shares issued is equal to fresh equity divided by the closing price. Fresh equity is equal to capital investment to be done minus the retained earnings. Investment to be done minus the retained earnings. I am not doing next question. Broadly the same requirement. The requirement remains same. Come to question 7. This is on Walter's model. Come to question 7. Come to question 7 on Walter's model. We'll come back for some of the question. 1 and 2 is done. 2 is on Modigliani Miller. Go through question 7. Okay, earnings is rupees 10, rate of capitalization is cost of equity, which is 10%. I have three options of paying dividend, either 50% or 75% or 100%. What should be the market price as per Walter's model if ROI is 15, 10 and 5? Now listen, Walter's model price is equal to D by KE R by KE into E minus D divided by KE. Now the dividend can either be 5 rupees 50% of 10 or 7 rupees 50 paise or 10 rupees. The dividend can either be 5, 7.5 or 10. So the dividend can be 5, 7.5 or 10. The rate of retained earnings can be, the R can be either 15, 10 and 5. The rate on the retained earnings can be 15, 10 and 5. So in this case it's 5 by 10% plus 15 by 10 into 5 divided by 10%. R D by K, D is 5 rupees divided by K 10% plus R by K 15 by 10 into E minus D, which is balance 5 whole divided by 10%. This is how much? 50 plus 75, 125. This is 7.5 by 10% plus 15 by 10 into balance 2.5. This is divided by 10%. 112.5. This is 10 by 10%. Other side is going to be 0. 10 by 10%, 100. Here R is equal to K. We can do the calculation, but everything will be 100. R is equal to K. When R is equal to K, whatever dividend you pay does not matter. Whatever dividend you pay does not matter. We can do the calculation in an exam scenario, but it will turn out to be 100 for all the three. This scenario, 5 by 10%, 5 by 10 into 5 by 10%. This will be 75. If you do the calculation, it will be 75. This will be 87.5 and this will be 100. In short, if R is equal to KE, any amount can be declared as dividend. If R is equal to KE, any amount can be declared as dividend. If R is greater than KE, ideally you should declare 0% dividend. As you increase the dividend, the value is coming down. Your dividend should be 0%. If R is less than KE, the dividend should be 100%. As you increase the dividend, the value is going up. So 125, 112.5 and 100. Best in the first scenario is 0% dividend. Second scenario, anything doesn't matter. Third scenario, you should have a 100% dividend payout. We should have a 100% dividend payout. Let's come to question 8. Following information is collected from the annual reports of Z Limited. Particulars amount, PBT, tax rate, retention ratio, number of outstanding shares, equity capitalization rate, rate of return on investment. What should be the market price according to Walters and Gordon's model? Both Walter and Gordon has been asked. Go through the problem. Okay, we are required to calculate the price of the share as per Walter and Gordon model. Before I start doing that, first I need the dividend and earnings per share. The earlier question said earnings per share is 10 rupees, dividend is 50%, 75%, 100%. This question, the earnings per share is not directly given. So first you will have to put it in the format which we normally do: EBIT less interest, EBT less tax, EAT less preference dividend, number of EAES, number of equity share, EPS. So first we'll have to get to that. Working note 1, computation of EPS and dividend per share. EPS and dividend per share. Particulars and amount. Earnings per share and dividend per share. We start with PBT less tax, PAT, number of shares, EPS and dividend per share. PAT can otherwise be called as EAES. PAT can otherwise be called as earnings available to equity shareholder. The PBT given in the question is 250 lakhs, 2.5 crores. Tax rate is 40%. PAT is 150. Number of shares are 50 lakhs. So earnings is 3 rupees and retention is 40%, which means payout is 60%. Dividend is 1 rupee 80 paise. Earnings is 3 rupee and dividend is 1 rupee 80 paise. First, under Walter model, 1.8 by D by KE. KE is 12% equity capitalization rate plus R by KE D by KE plus R by KE into E minus D whole divided by KE. 1.8 by 12% is 15. This side how much? 15 by 12.5. 27.5. This is as per Walter's model. Under Walter's model, we will not have a confusion of D0, D1 assumption and all. That confusion will not be there. When it comes to Gordon's model, the dividend which you have calculated can be taken as D0, can also be taken as D1. That's a confusion we had when we were doing cost of capital. So P naught is equal to, if I assume it to be D0, 1.8 by KE minus G. Cost of equity is 12%. Growth rate is ROE into retention ratio. My ROE is 15%, retention is 40%, which is 6%. Both the approaches will not give the same answer. If you change your assumption under Gordon's model, the answer will change to 31.8. If you take it as D0, the answer is 31.8. If you take it as D1, the answer is 30. That's a confusion which will always be there under Gordon's model. Try question 9. Try question 9 quickly. Under Gordon's model, do question 9 quickly. Question 9 under Gordon's model, please attempt it. We'll discuss. Same way, first calculate the earnings per share. The dividend can keep changing based on the scenario. Get the earnings per share. Try question 9. Please attempt it. You will struggle somewhere when you do 25%. You will find one challenge. Your growth rate will turn out to be more than cost of equity, which indirectly means Gordon's cannot get the answer. Gordon's model cannot give you the answer for 25% payout. If you do 25% payout, the growth rate will be 15%. Growth rate will be 15%. So as per the Gordon's model, the cost of equity should be greater than the growth rate. Growth rate is, and hence price cannot be computed as per Gordon's model. Price cannot be computed as per Gordon's model. So I wanted you to face that. When you do it only, you'll understand. The growth rate has to be lower than the cost of equity in the practical world, because what is the formula for cost of equity is D1 by P naught plus growth rate. So growth rate obviously has to be lesser than cost of equity. If it's more, then there's something wrong with the data. Second scenario, it will be 5 rupees divided by 14 minus 10%. Third scenario, 10 rupees divided by 14%. Quickly get the answer to question 10. Get the answer to question 10, Gordon's and Walter's formula, both. Question 10. Gordon's and Walter's formula. Both Walter and Gordon needs to be done. Gordon, Walter. Huh. Is there a light coming there? On, is there a light in the projector? Projector. There's a light. No, no. Is there a light? What is the color of the light? It's blinking. Yeah, like it is happening for the last 2-3 minutes. So once we this is a switch, right?
No, red light. No, green. Green blinking. It'll take 1 minute.
Just give me a minute. You try question number 5. If you are done with this, try question number 5. Try question 5. Do question 5. The balance questions I'll take you through. Do question 5. Do question 5 quickly. Which one? Which alternate answer? Gordon's model. That dividend which you calculate, you can either take it as D0 or D1. That's the assumption. No, that's a typing error there. It's just a typing mistake. 18 minus 16.5 divided by 1.5%. Would have copied it from some other question, so in that I think there's a typing error there. Okay, I assume you have practiced question 5. I'll do some more questions which has some learnings there. Let's come to question 4. Question 4. The following figures are collected from the annual report of XYZ Limited. Net profit, outstanding preference share, number of equity share, return on investment, cost of equity. What should be the approximate payout ratio so as to keep the share price 42 by using Walter model? So we are going to calculate dividend which will give the share price of 42. This question had come once in exam where they missed this data. The cost of equity got missed out in the question. Another time when it came in exam, they have given the cost of equity. So if such a question comes and they miss out that cost of equity, we have to assume a number and proceed ahead because the question did not have that data. Now they want us to calculate what should be the payout ratio so as the share price is 42. Let's use the formula of Gordon's model. 42 is equal to D by K is 16%, D by 0.16, R by K 0.20, 0.16 into E minus D. My earnings per share would be 30 lakhs minus 12 lakh of preference dividend. 30 lakhs minus 12 lakh of preference dividend, which is 18 lakh, divided by 3 lakh shares, divided by 3 lakh shares, which is 6 rupees. So 6 minus D. 0.16 is common here. 42 into 0.16 is equal to D plus 1.25 into 6 minus D. 0.20 divided by 0.16 is 1.25 into 6 minus D. 42 into 0.16 is how much? 6.72 is equal to D plus 7.5 minus 1.25 D. Net, can you calculate D how much it turns out to be? $3.12, which is broadly 52% payout. 3.12, which is broadly 52% payout. So if you have a dividend payout ratio of 52%, if you have a dividend payout ratio of 52%, we will get the share price to be 42 for the given information. Determine the optimum dividend payout ratio and the price of the share at such payout. Optimum is depending on the relationship between R and KE. R is 20%, KE is 16%, R is 20%, KE is 16%. The optimum payout ratio is how much here? 0, and the price at that optimum payout ratio is 0 by 16% 0.20 by 0.16 into 6 whole divided by again 16%. Calculate this price. 7.5 by 16%. 46 point. The question wanted only price of 42, which worked with the 52% payout. Here 46.875 is the price if you work with the payout ratio of 0%. 0% is the optimum payout ratio. Prove that the dividend payout ratio is optimum by using random payout ratio. Now, this is one of the question which came recently in exam. Random payout ratio, they wanted us to, the optimum payout ratio is 0%. You take any number other than 0, the price should be lesser than 46.875. You can take 10% and 20%, two numbers, or 14% and 25%, 25% and 50%. So, they have taken a random payout ratio of 25, 50, 75, 100. At all these levels, price would be lower than 46.875. 46.875 was the maximum price which was at a 0% payout ratio. Any random payout ratio other than that, just two ratios are also fine. We are proving that fact that the optimum payout ratio in this question, the optimum payout ratio in this question has to be 0%. Go through question 3. Go through 3. Okay, I'll do some of the points to be discussed here. The share capital is 25 crores, reserves is 15 crores, profit after tax 3.7, dividend paid is 3 crore. Can you tell me 3 divided by 3.7 is how much? 0.81. So 82% basically. You have paid a dividend of 82%. Comment on firm's dividend policy. See, dividend policy will depend on the relationship between R and KE. If R is greater than KE, the optimum payout ratio is 0%. If R is less than KE, the optimum payout ratio is 100%. And if both are same, any amount is fine. So, I am not sure whether they have done the right thing. They would have done the right thing if R is equal to KE, because any amount of payout is fine. Now, dividend is 3 crore by 2.5 crore shares, 1.20 per share. Dividend is 1.20 per share. Earnings is 3.7 by 2.5. How much is this? 1.48 per share. Price today is, the earning P ratio is 26.7. So, price today is 1.48 into 26.7. How much is this? 1.48 into 26.7. 39 point. Okay, that's the price today. Now listen, K is equal to D1 by P naught plus growth rate. K is equal to D1 by P naught plus growth rate. I'll come to this in a minute. D1 by P naught plus growth rate. R is equal to return on equity. R is equal to EAES by amount of equity. The company has earned a profit of 3.7 crore. Amount of equity is 25 plus 15, 40 crore. Let me know what is the return on equity. 3.7 crore by 40 crore. 9.25. Growth is equal to ROE into retention ratio. ROE into retention ratio. 9.25. Retention is 100 minus that 82%, 18% broadly. You can do the exact calculation also. It was 82% of payout, so 18% would have been the retention. How much is the growth rate? How much? 1 point? Okay, 665, so 67%. Let me take it as 1.67. So my cost of equity is going to be 1.2 by 39.516 plus growth rate of some 1.67%, whatever number you had calculated, plus the growth rate. This will give you the cost of equity. This 1.20 can be assumed as D0, can be assumed as D1. Based on that, answer can change. So net the calculation till now is like this. The cost of equity is 4.84. The cost of equity is 4.84. The your return on equity was 9.25. What is the optimum payout ratio here? What is the optimum payout ratio here? Cost of equity is 4.84. Return on equity is 9.25. 0% is optimum. The company has ended up paying some 81%. The company has ended up paying some 81%. So they are not following the optimal dividend policy. The firm has a dividend payout of 81 with the value of the share at this. The rate of return is 9 point and it's more than the cost of equity, is not following an optimal dividend policy. If you follow the optimal dividend policy, it will be 58.44. It will be 58.44. The last requirement of the question is, find out what should be the P ratio at which dividend policy will have no effect on the value of the share. Dividend policy will have no effect on the value of the share if R is equal to KE, 9.25 is equal to D1 by P naught plus your growth rate. D1 by P naught plus growth rate, you try to get to a balancing figure of P naught. You try to get to a balancing figure of P naught, and based on that you do the calculation. You get a price of 16.28. You get a price of 16.28 and the P multiple turns out to be 11 times. The P multiple turns out to be 11 times. Because now what happens is, I want the return on equity to be equal to cost of equity. The return on equity has to be equal to cost of equity. That is possible if the price is 16.28, which indirectly mean the P multiple is 11 time. The P multiple has to be 11 time. If it's 11 time, R is equal to KE. Okay. There are 2-3 areas which is not there in my material. One is, there will be one problem on step up growth model. You may find it in your regular material, or also it's covered in the additional question. You can just see that. And one or two question, please see it on Graham and Dodd model and Lindner's model. Those questions have not been covered because they have not been tested in exams till now. The material has only those questions which have been tested either in your MTPs or RTPs. So with that, I think we have kind of covered comprehensively whatever areas needs to be covered. We have done that. As I said during your costing part, after this, try to first complete the material fully. Some of the questions, if we have not discussed, in FM I have discussed more questions than what I did in costing, so the coverage could be slightly better, but still most of the questions I would have done at my end. So I would want you to complete the revision material and then write some mock test. If you write mock test, I think that should kind of take care of the preparation. I'll end with this. If there are any doubts, you get back to me. Sure. Thank you, friends. Thank you.